Imagine waking up one morning, checking your brokerage account, and seeing that you've been paid money while you were sleeping. Not because you worked overtime, not because you started another side hustle, but because you own shares in great businesses that reward shareholders with passive income. Now, let's be realistic. Passive income isn't magic. It's not a get-rich-quick scheme. And despite what some influencers on social media might tell you, there is no secret investment that turns $1,000 into $1 million overnight. But there's a proven strategy that many successful investors have used for decades: owning quality dividend-paying companies and allowing time and compounding to work in your favor. And when it comes to dividend-paying businesses, few industries have a longer history than banking. Over the past several weeks, I've been researching some of America's largest banks, looking at their dividends, their earnings, their growth opportunities, and perhaps most importantly, whether I would actually feel comfortable owning them in 2026. Because let's face it, not every bank stock deserves your money. Some offer attractive dividends but weak growth. Others have strong growth but very little income. The best opportunities usually combine both. So today, I'm sharing the 5 U.S. bank stocks that I believe deserve serious attention in 2026. We'll discuss the opportunities, the risks, and if I had $10,000 to invest today, which one I would personally choose. Let's begin. Number 5, Wells Fargo. Let's start with Wells Fargo. And honestly, this stock almost didn't make my list. For years, Wells Fargo struggled with scandals, regulatory issues, and damaged public trust. Many investors simply moved on, and I can't blame them. Trust is everything in banking. Once it's lost, it can take years despite all the headlines. Wells Fargo remains one of the largest financial institutions in America. Millions of customers still use its services. The company continues generating billions in profits, and management has spent years trying to clean up past mistakes. Now, does that mean the turnaround is complete? Not necessarily. But I do think the market may still underestimate the progress that's been made. From an income perspective, Wells Fargo offers investors a respectable dividend while maintaining room for future growth. What I find interesting is that many investors still view Wells Fargo through the lens of its past. Sometimes, that creates opportunity. The biggest risk? Regulatory restrictions and execution mistakes. If management stumbles, investor confidence could quickly disappear. Why buy Wells Fargo today? Possibly, but only as part of a diversified portfolio. For me, it remains more of a turnaround opportunity than a core holding. Number 4, U.S. Bancorp. Next up, U.S. Bancorp. This is one of those companies that rarely makes headlines. And honestly, that's part of the reason I like it. When researching investments, I've learned something interesting. The companies creating the most noise aren't always the best investments. Sometimes, the winners are the businesses quietly executing year after year. That's exactly how I view U.S. Bancorp. The bank has built a reputation for strong operational efficiency and discipline management. It focuses on traditional banking activities, serving consumers, businesses, and communities across America. What impressed me most was consistency. During good economic environments, the bank performs well. During challenging periods, it tends to hold up better than many competitors. For passive income investors, that's important because dividends become much more attractive when they come from stable businesses. The dividend yield is generally competitive, and management has historically shown commitment to returning capital to shareholders. Now let's talk risks. Like all regional banks, economic slowdowns can impact lending activity. Loan defaults can rise, and profit growth can slow. But compared to many banks, U.S. Bancorp feels remarkably steady. If your goal is dependable passive income, this stock deserves a close look. Number 3, PNC Financial Services. Now let's move to a stock that I believe many investors overlook. PNC Financial. When I first started researching bank stocks, PNC wasn't at the top of my list. But the deeper I dug, the more impressed I became. This is a bank that combines size, financial strength, and disciplined management without receiving the attention that larger banks often get. What stands out most is the dividend. Income-focused investors frequently appreciate PNC because of its shareholder-friendly approach. But dividends alone aren't enough. A company also needs a healthy business model. And that's where PNC shines. The bank has expanded strategically over the years, strengthened its balance sheet, and maintained a focus on profitability. One thing I always ask myself when researching dividend stocks is, can this company continue paying and growing its dividend during difficult times? With PNC, the answer appears encouraging. Of course, nothing is guaranteed. A recession could pressure earnings. Higher loan losses could impact profitability, and changing interest rate environments can affect banking margins. Still, among income-focused bank stocks, PNC remains one of the most attractive names I've found. If passive income is your primary objective, PNC could easily deserve a place on your watch list. Number 2, Bank of America. Now we're entering the heavyweights. Bank of America. And here's something interesting. Whenever I research major banks, one name constantly appears in conversations about long-term investing: Warren Buffett. For years, Bank of America has been one of Buffett's significant investments. Now, I never buy a stock simply because a famous investor owns it, but I do pay attention because great investors often see opportunities others miss. What makes Bank of America attractive? Scale. Massive scale. Millions of customers. Huge deposit base. Credit cards. Mortgages. Wealth management. Commercial banking. The company touches almost every corner of the financial world. What I particularly like is its ability to benefit when economic conditions improve. As lending activity increases, Bank of America often sees stronger revenue opportunities. The dividend is solid. The business is diversified, and management has demonstrated an ability to navigate challenging environments. Now let's discuss the downside. Large banks face significant regulatory oversight. Economic recessions can hurt profits, and competition remains intense. But overall, Bank of America strikes a compelling balance between growth potential and passive income. If someone asked me, which bank stock offers both income and long-term appreciation potential, Bank of America would be near the top of my answer. Number 1, JPMorgan Chase. And finally, my number 1 bank stock for passive income in 2026, JPMorgan Chase. Honestly, this choice became clearer the more research I completed. Every time I compared balance sheets, earnings power, business diversification, and management quality, JPMorgan consistently rose to the top. This bank is an absolute giant. Consumer banking, credit cards, commercial lending, investment banking, asset management. The company operates at a scale few financial institutions can match. But size alone isn't why it ranks first. What truly separates JPMorgan is execution. Year after year, the company demonstrates an ability to perform during both strong and weak economic environments. That level of consistency is incredibly valuable, especially for long-term investors. Another reason I like JPMorgan is leadership. CEO Jamie Dimon has become one of the most respected voices in global finance. Whether markets are booming or struggling, investors pay attention to what he says. The dividend yield may not be the highest on today's list, but here's something I've learned over the years. The highest yield isn't always the best investment. Sometimes, the best investment is the company most capable of increasing that dividend for years to come. That's where JPMorgan stands out. If I had $10,000 today, and I could only buy one bank stock, JPMorgan would likely be my choice. Not because it's guaranteed to outperform. Nothing in investing is guaranteed, but because it combines quality, income, growth potential, and financial strength better than almost any other bank I researched. Before you rush out and buy any stock, I want to leave you with one important lesson. The goal isn't simply to find the highest dividend. Many investors make that mistake. They see a huge yield, get excited, and completely ignore the underlying business. That's dangerous. Instead, focus on quality. Focus on sustainability. Focus on companies that can continue generating profits for years into the future. Because that's where true passive income comes from. Not from chasing hype, not from gambling, not from trying to get rich overnight, but from owning great businesses and giving them time to work for you. Personally, if safety were my top priority, I'd choose JPMorgan. If I wanted a balance between growth and income, I'd look closely at Bank of America. If passive income were my primary goal, PNC would definitely catch my attention. And if I believed in turnaround opportunities, Wells Fargo could be interesting. The key is matching investments to your goals. Remember, diversification matters, patience matters, and perhaps most importantly, time matters, because the real power of passive income isn't the first dividend payment. It's the hundreds of payments that can arrive over many years. That's where wealth is built. So now I want to hear from you. Which of these 5 bank stocks would you buy today? JP Morgan, Bank of America, PNC, US Bancorp, or Wells Fargo? Leave your thoughts in the comments below. If you found this analysis helpful, subscribe for more investing research, dividend ideas, and long-term wealth building strategies. Thank you for watching. Stay patient, stay disciplined,